Markets look confused. Things are up, down, sideways, kind of more down than up. I think markets are worried. Investors are worried that the Fed might not be quite so easy, might thinking about snatching that punch bowl away. I will say, I think a major policy change, or even any substantial policy change, is very unlikely. But just the tea leaf, of the oracle's cup there, when Powell puts his cup down and everybody looks over the tea leaves of words. What did he say? What does it mean? Oh, he changed happy to glad. Expect a lot of volatility. I don't expect serious policy changes. But the changes in the verbiage could really rattle the markets. And ultimately, despite any short-term volatility, I think that will be good for gold and silver. Is if you look at the big picture, that most relevant of time frames from 1971 till now that we started this conversation on, you can see the value of the dollar, purchasing value of the dollar going down, and gold going up, right? So that great big X on the chart tells you that it's an artificial construct. When these sources, I saw it on CNBC the other day, other places, there's a lot of people out there saying, oh, there's no correlation between gold and inflation. Well, there's artificial reasons for that. And the reality is, over time, we all know that over the centuries, gold holds its value, and paper money, fiat money, money carved on sticks, money in cowrie shop, all kinds of other monies go the way of the dodo, and gold still holds value. In some ways, this might seem like a no-brainer, right? Gold is priced in dollars. Gold should be inversely related with the dollar, and it generally is. But for all these decades, people have been scratching their heads like, why doesn't gold relate more inversely directly to the dollar? And the reason for that is that the so-called strength of the dollar is hard to measure. I mean, I think realistically it should be measured by inflation, but that's not how people look at the dollar or any currency. They look at it in the foreign exchange markets. So you have periods where the dollar looks strong, right? The dollar is rising. Doesn't mean the dollar is actually strong. It just means the other currencies are crappier. So the dollar is losing the race to the bottom and therefore looks strong. That's not real strength, and that doesn't relate to gold. So the dollar itself has been less useful as a direct guide in the short term versus gold. It hasn't correlated as well as real rates. So what we're seeing in the last couple months, really this year, is that the relationship between gold and nominal rates as a proxy for real rates is getting fuzzy. It's getting weaker. It's still there, but there's a lot more noise. Whereas the relationship between gold and the DXY as a proxy for the dollar is getting much stronger, much more closely, even on a day-to-day basis. You'll see that gold and the dollar's lines look much more like mirror images than gold on real rates. Not every day, but pretty consistently so far this year. And what does this mean? Here I can only theorize, right? I don't know this for a fact. I can't ask everybody in the marketplace, why are you doing this? But my thought is that, one, traders in New York and London, these places, the people who trade these futures contracts, are getting the message that nominal rates and CPI are not giving them the real data they need. They're getting as cautious and suspicious as we gold bugs about this transitory story, and they're looking for other measures. Their algorithms are not being programmed, or not all of them anyway, are not being programmed to knee-jerk react to nominal rates as being a reason to buy or sell gold when they fluctuate. And maybe more of them are programming the dollar directly now, since there's a reason to discount the information coming on inflation. That's one aspect. I think another aspect is you just look at the overall situation. You look at the money printing, the race to the bottom. I think there's evidence that suggests that large institutional players, sovereign wealth funds, not just China and Russia that are not enamored with the dollar, but the broader picture out there of international money, big family offices. I think there's serious money that, frankly, they don't care whether gold pays interest rates or not anymore. They are worried about the dollar. They see the problems with what's happening in the United States, the monetary and fiscal policy, what that implies for the dollar. And so I think you're starting to see larger players. I can't prove this. It's my theory, my explanation for what the data is saying. The data just shows a relationship. My interpretation is traders discounting inflation information as being unreliable, and large institutions saying they don't really care about interest rates so much anymore. They're worried about the dollar. They want something safe that isn't the dollar. They're not all ready to jump on Bitcoin yet, There is something else, though, that has worked for thousands of years. And so that's what I think this data is suggesting to us. No, not suggesting. I don't want to be mealy-mouthed here. That's what I think the data hints at right now. I buy gold bullion and silver bullion because it is physical value. It is a financial asset for which I can be long, and there is no short counterparty. And what's different from that, your point about this question is correct. You know, other things hold on to value. A house still has value. You know, and prices go up, prices go down. I can still live in my house, right? It still has the same number of rooms, same number of bathrooms. I can sleep in there, right? It has a utility to me, and that underpins its value. Whatever the prices do, it's still a house. Same is true for an ounce of gold in my hand. Whatever happens to prices or markets or whatever, it's still an ounce of gold. It could still be turned into X amount of jewelry or X amount of electronic gadgets. It is different, though, in that gold is uniquely recognizable, a uniquely compact form of value, uniquely resistant to corrosion in a physical sense, as well as in the monetary sense. So it has special properties that make it particularly useful and more liquid than other real things. I just had a person on my Twitter feed this morning who responded to this inflation question and a jibe I made about Powell. And he said, okay, so if it's not transitory, what do you protect yourself with? And I guess he wanted me to say gold, and of course that is one thing. But my answer was actually real assets, which fits with your question. Of course, if you see destruction of fiat currencies, then anything real is going to do well compared to these not real imaginary things that we use because governments pass laws telling us to. You know, absent that, the market would choose something else. It always did. So silver's convenient in that it's got less value than gold packed in the same space. So for making change, basically, it's useful to have silver around. But gold for long-term storage of value, it's just hard to beat. It's got all those things that Aristotle talked about thousands of years ago, right? And it's so recognizable, the yellow metal. We talk about the other yellow metal, but that's uranium oxide. It's not actually, uranium itself is gray. Vanadium, by the way, the oxide is also yellow. So you could talk about three yellow metals, but those other metals are not yellow. Gold is recognizable. Okay, it's possible to put tungsten wrapped in gold or something. It's possible to spoof people with gold, but it's not easy and it's not cheap, and it's not the sort of thing that the average person needs to worry about. You go down to your local coin shop, and they have tested these things, or they're slabbed. It's an easy way for the average person who isn't a professional or isn't a banker and so on to have highly liquid long-term savings that are proof of any level of idiocy that governments go to.